value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
And Jim, thanks as always for having me.
Tim, Hurricane Sally rolled through your neighborhood, I think, about 6 weeks ago. Everything okay now?
Oh, yeah. We're already forgotten about all that.
Enough hurricanes go through the Gulf, I guess, that you get used to it after a while. Tim, since the Fed was invented back in 1913, our market historian Bob Hoy has pointed out we're now in our 19th recession since the Fed was invented, and they said the whole reason of it was to prevent recessions and depressions, and yet we've had so many since then. Is the Fed really worth the effort and time, or are they just a self-serving bunch of bankers?
Well, it certainly isn't to prevent recessions, and as I think you were alluding to, because that's obviously, 19 failures at such an attempt, then it's not too much of a success record there, is it? But speaking of the economy here and the Fed trying to save it, I think is the point. Is that we're officially in a recession again here, and we've seen all these efforts to try to save the market and prevent the recession and that sort of thing. And we hear Powell, he'll come out, and I'm not picking on him. I mean, if you or I were in his shoes, we'd probably do the same thing. But he comes out and if you notice, it's a pattern. He come out and they got a bigger toolbox. So we're going to do more now. He got a bigger toolbox. Well, now we're really going to get tough. And it's just, it's a game. Man, it's a game. And, I don't think that they can, obviously they've kept the market up, but they can't fix this economy. If they were going to fix it, they would have fixed it, years ago. If you look back at some of the data, and we've talked about this, it's been a while, so there may be new listeners, but, the economic data, when you really look at the data from an unbiased, objective point of view, what you see is that this has literally been, when I say this, the post-2009 recovery has literally been the weakest since the Great Depression. And when I say that, I'm looking at, the employment growth rate. The employment numbers have been so heavily skewed and manipulated and used as a political tool of, created so many jobs and so on and so forth. But when you look at the growth rate and the actual numbers, it's not true. When you look at the manufacturing numbers, it's not true. When you look at the boxcar traffic, it's not true. When you look at the credit contraction that's going on, it's not true. When you look at lending practices from the banks, I covered that in one of the research letters. The banks are very, very tight with credit, so they can lower rates all they want. But if the consumer isn't buying and borrowing, and the banks aren't loaning, and the jobs aren't there, and then on top of that, we have this. We're headed toward the stages being set now for another lockdown. It's what's another little piece of tidbit that's in, I think for the last, 7 weeks, the unemployment claims have been 900,000 jobs. I mean, come on. They're not fixing this. They can't. What are they waiting on? You didn't do it, a year ago, 2 years ago, 3 years ago, 4 years ago. And so, I think that it's just they're trying to contain as best they can, which again, you or I were in their shoes would probably be doing the same thing. And they have done a magnificent job at holding the market, gaming the market. But as far as fixing the economy, no. absolutely not. And the market is being used. I mean, if you look at the news, they say, hey, look at the stock market. The economy's great. And so just like we've said all along, the market is being used as a cover story to point to and say that the economy's great. And that's just not so.
If the Fed is going to try to fix this, is there anything they can do, Tim? Or is stimulus money wasted money? Eventually the market's going to collapse no matter what the Fed does.
I mean, personally, I think it's wasted money. If I don't know. If I were, we say, well, if I were them, I'd do so and so. But, if I were in their shoes and I was trying to stimulate the economy, I think I'd do something like they did back in the 1930s with the work program, when he built the interstate system and built the dams and, bridges and, infrastructure for the country and put people to work. I mean, to me, that would be much more stimulus and productive and actually, providing jobs and doing something for the economy, for the country as far as infrastructure, something usable, the interstate systems and so forth. But, what they're doing here, cutting interest rates, really? Saying you're going to let inflation run, we're going to let it run hot this time. We're going to let it run come on, man. No, that's not stimulating the economy, and the numbers prove it.
Well, how does inflation help the economy if prices are higher but people don't have jobs to buy the things that cost more?
Exactly. I agree. I mean, we are seeing some inflationary pricing and things. I mean, if you think about it, with the economy being shut down and with the storms and so on and so forth, I mean, it is driving the price of certain goods up, but that is because you can't find the goods. I mean, there's a demand for lumber, but that's not because the price is not being driven because of a growing economy. It's being driven because of a scarcity of the product, and then on top of that, like you said, you have the shrinking. The shrinking job base, and people lost jobs and closed businesses and so on and so forth. So it's like it's actually compounding the problem, not helping.
And of course, a lot of the people employed in the U.S. were in the service industry, and that was the first to suffer with the lockdown. No more restaurants, pubs, hotels, airlines.
Exactly. I don't fly, but I know that from my understanding that that's light. I took someone to the airport yesterday and, just pulled right up to the front door. It's a relatively, I'd say small to medium-sized airport, but I mean, there's not an excessive amount of traffic there at all.
Mm-hmm. And where I live in Vancouver, I'm right at where the airplanes turn to approach the airport. And on Sundays, the sky was just filled with A-10 or A380s, the biggest airplane in the world, the Qantas, Singapore Airlines. There's nothing out there. The skies are completely quiet.
Right. Well, the point is, yes, we are definitely in, a recession. And I think they are doing what they can to try to, stimulate, but it's not stimulus. It's not working. It's a matter of containment. And, that game is gonna work until it doesn't. And, from my seat, it's all about market structure. And, I don't know. I think it's gonna happen fast. I think it has to. When I say fast, it's going to be like back in January, February. I think going into that high, I said, this thing's going to set up so quick, the structure's going to fall in place, and bada bing, bada boom, and it's going to crack. And I think that's what we see here. It's going to, the market's going to allow this to go on and go on and go on until it doesn't, and then we see the structure, and the structure's all we got. You can look at this and say, the credit, lending policies are tight, and we can look at job numbers, and we can look at, interest rates. We can look at that. That tells us the big picture. That tells us the environment we're in. But when we actually see the structural setup and the crack, and we'll know it's the crack because of the structure, then we know. And I think it's going to happen quickly and seemingly out of the blue, just like back in February, which, by the way, I think it really started to come unraveled. And I think they almost lost control, and they were able to, pull it back one more time. Can they do it again? I don't know, flip a coin. But structure is key. And we have this election coming up. I don't know. Typically, I don't think the election matters. I've done a study. And, and I've talked to other people who've done other studies too. I'm not so sure that the election matters from what I can tell, in short. But once we get the election past us and, the market's kind of anticipating that and hanging on here, regardless of the outcome, it could fall in place so quickly.
We'll have more with Tim Cyclesman Wood right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's going on with crude?
Well, crude oil, I think, I've been saying that all asset classes were setting up to peak together, go down together, and I mean at a higher level, but on a short and intermediate term basis, they did the same thing. We had the intermediate term tops back in August, September, and then we went down into this mild low in the end of September, and now everything's kind of rebounded. Like I said, it's levitating, I think, in light of the election, and we get that uncertainty out of the way, and then the market will do what it's going to do. But long story short, I think crude oil, it's been in a counter-trend bounce just like equities, and I think that, we're going to see the setup there and everything goes down together. I'm sticking to that because that's what I see. And, on that note, we were talking a little bit before we came on the air, and if I could, can I give a little bit of an oil analogy to the economy here? Just a little bit of a story.
Oh, absolutely.
Parallel.
Yeah, go ahead.
Well, my nephew works in the oil field, and in the Gulf, and so I have a little bit of insight just in talking to him. He's young, but he's been out there for probably a dozen years or so now. So he was there during the boom, and so we talk, and he was telling me, he said, back in 2011, 12, that time frame, he said that if you came into port in South Louisiana, he said there was some of those ports, he said it would take 3 hours just to get out of port because of all the I say ship, they call them boats, but it's oil related, support vessels for the oil industry. And he said if you didn't own one of those docks, you had to come in and, take care of business and get out of there. But, it'd take hours to get out of the port because of the traffic. And now I was looking at some data, the rig counts and that sort of thing, and the oil industry is bad. It's tough out there for them. And, they're not paying like they were, before. They couldn't pay those guys enough money. They were giving them bonuses, crazy money. They were building new ships. They were building, rigs. It was off the chart. And all that was really happening. It started happening, of course, in 2007, 8, but it continued into 10, 11, 12, and 13. And looking at the oil field and the price of crude oil and commodities in general and that sort of thing, Oil obviously peaked in 2008 at what, 140 whatever dollars a barrel, 42, 47, whatever it was, and then it crashed all the way down to like, what was it? I don't remember. Yeah, I think it got down into the 20s or 35, 30, whatever. And then we had that big rebound and went back up to over 100 and kind of levitated there for a couple of years. Well, everybody thought that, I say everybody, is that industry. They thought that's the time frame he was talking about when he said everything was booming out there and they were building and going crazy and paying and so forth. Everybody thought it was on. We had a correction. It's behind us. We had a correction. Everything's good. They're blowing and going. And like I was telling him, I said, but you couldn't have told them otherwise. If you had told them, just like I'm saying now, we've been talking about this market being held up by, we called it bullshit and bubblegum a couple of last interview, that the Fed's really not, they're I can't say out of bullets, but almost out of bullets, virtually out of bullets, because they're holding you together with speech, and assurance. But I digress. But anyway, if you had told those people who were building those boats back then, said, hey man, this thing's over. This is a dead cat bounce. This isn't going to last. But it appeared to last for a couple of years while crude oil levitated there around that $100 mark. And it just kind of held on, and then it really cracked. A lot of those stocks are down now 95%. Some of them are bankrupt and out of business. They would not have listened to you at that time. They wouldn't have heard it. You're like, dude, you're crazy. Get out of here. There's no way possible that they would have listened. It fell on deaf ears. And that's the situation. What I'm trying to do is draw the parallel with now. People aren't listening. There's no way. Trump 2020 mega, everything's great. Well, this is great. We're post-COVID, it's behind. Everybody thinks everything's okay. And we're being cheer-led along to believe that. And I don't know how fast. Like I said, from my seat, it's the structure that matters. But it's not okay. I think that the parallel I'm trying to draw is that I think that the equity market is going to resemble what we saw or what they saw with oil stocks in the oil field. It's not sustainable. How long it can last, I don't know. But again, I go back to it's the structure. That's what we have. And the fact, another parallel here, is that the fact that the oil market, if you look back in history, looking at the data, there's no time where, if the economy is strong, then there's the demand for the oil. So the fact that we've seen this whole last 4 years of this economy with weak commodity and weak oil prices, it's telling us something. And that also confirms the long-term data. We haven't talked about this in a long time, but the long-term data where I have said that we're rolling over out of the sixth economic cycle since the Great Depression. And I have data, since the Great Depression, since 1800. The sixth economic cycle, long-term cycle since 1800. It's clear that we're rolling over out of that cycle. And hear what I said. The sixth economic cycle since 1800. And so what I'm saying is that these commodity prices, oil, it's reflective of that. The fact that the Fed is having to talk up the market and say that we're gonna do this and we're gonna do that and we cut rates and we have to do the non-QE QE and the QE and whatever infinity and all the bag of tricks. They're not doing that because things are great. They're doing it because they're fighting that sixth economic cycle, and so far the market's kind of bought it, and this has been going on for a little bit, but it's not sustainable. Is this election going to be the catalyst to where, okay, that's out of the way now and kaboom and it goes? I don't know. Again, I go back to the structure. But that is the environment that we're in. That's as good a parallel as I can draw, and at some point, just like with the people who didn't listen or didn't have the foresight to see or whatever the case may be about the oil industry back then, it's going to be the same way with the stock market now. People riding around with thinking everything's okay here now, not listening, at some point they're going to be crying in their milk, well, why didn't you tell me? Well, we tried. You wouldn't listen.
We'll have more with Tim Cyclesman Wood right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, the U.S. Fed has said it's going to keep interest rates ultra low for the next few years. Is that very damaging for banks, pension funds, and the insurance industry?
Well, I don't know about that, but they're going to keep interest rates. Let me address it this way. They're going to keep interest rates low until the market allows them, or should I say, forces them to raise the rates. And the evidence of that is real clear. And it's been a while since we've talked about this too, but you can literally take the data from the 90-day T-bill and I have the data going back into the 1940s, so I know what I'm saying. And you can take the Fed funds rate or the discount rate, whichever, and overlay the two, or plot them, or look at them in a graphic, in a spreadsheet, or however you want to look at them. And the Fed follows. They follow when rates start to decline. They follow when rates turn up. And sometimes they'll let that spread get a little wider. Sometimes they don't. Depends on how aggressive they want to be. But they follow the market. That's a fact. And so that's another, so what you've just said is that's another perfect example of them telling you they're going to do one thing when in reality it's not exactly so. They're telling you they're going to keep rates low. Yeah, you're going to keep them low until the market forces you to raise. That's the reality. So I think that people think that low rates are stimulus. Well, that may be if you're cutting rates from, 15% to 10, but when you're cutting rates from 2% to nothing, that's not stimulus, that's a problem. And if it were stimulus, then why is it that the bank credit lending practice or policies are so tight, and why is it that the consumer credit is contracting if it's stimulus and it's so positive?
Tim, does this mean that the drop in March will be nothing compared to what the stock markets are going to face in the near future?
Once control is lost, I don't know how the unwinding, the process is going to really look, but I want to say the answer to that is yes. It is going to be nothing because it's a ginormous. This has been going on for years. If you go back and put it really truly in perspective, how big this is that the organic, from my work, the organic top in the economy and the stock market, it tried to peak in 2000. And if you think about it for a minute, just think back and clear your brain and, everybody, remove your biases and just think, that's when we saw, like I said, at the end of the dot-com bubble. That's when we saw simple things like, the volume characteristics of the market change. That's when we saw, somewhere around there, we saw the velocity of money peak. We saw the job participation rate peak. We saw all these things, these just real broad brush stroked indications of the economy. Everything peaked back in 2000, and then it was right after that they really started ramping up the efforts to do what? To reinflate. To fight what? Deflation. And so that's where it began. And then, we rolled over. They finally, they created, people have forgotten about this too, but these efforts created the worst financial crisis since the Great Depression. Literally, that was the words that it was termed when the bubble in 2007 popped. But then as we come out of that, what they did, leading into that 2007 top pales to comparison to what they've done here. And so, but my point is that they've done more of the same on steroids. So they've created an even worse problem as far as the size of the bubble. And yes, that's what it is. And yes, it's held on. No doubt about that. So, but at the same time, when you look at the underlying data, like I said, the growth rate with jobs, the contracting credit, simple things like boxcar traffic, real ISM manufacturing numbers, on and on and on and on. We've got a list of them that we've talked about before. Everything is telling us that it was the worst the worst recovery. The post-2009 recovery was the worst recovery since the Great Depression. It had already begun to contract, depending on what you're looking at, somewhere between 2011 and 2015, the data began to contract. So the recovery was what recovery was there was already waning. Then you throw this COVID thing on it, and the Fed continues to do everything they can to hold things, and all it is it's a matter of containment. So how can it end well? I don't have the crystal ball. I don't know. Maybe they can do this. So they've done it a lot longer than anybody imagined, but it doesn't change the environment that we're in. It doesn't change the fact that we're, that the economy is virtually non-existent. It doesn't change any of that. So, common sense tells me, yes, it has to end badly. But again, we have to get that set up. And then once we do, and their efforts fail, it's going to tell us that, how do I say this? Once the setup is in place and they do whatever they're going to do and the market doesn't respond to it, then they've lost control. And who knows what the outcome of that's going to be? I don't know. I don't know how you get out of a situation like we're in and it end well. Another thought, I'm rambling a little bit, but another thought on that, and I mentioned this before. What manipulated market in history has ever been sustainable? I've asked that question before. Name one. What bubble in history has ever not popped? Name one. So we have this ginormous market advance that everybody thinks is somehow mysteriously normal, and it's built on literally nothing, a house of cards, and Fed speak, and no economy. How does it end well?
Tim, thank you so much for chatting with us.
You're welcome.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.